Bangladesh, the birthplace of modern microfinance. The model has been an inspiration to many countries to reach millions of people and businesses by creating opportunities for better money management and taking small loans to improve their livelihoods. In Bangladesh, around 800 MFIs are offering 25 million people and micro-businesses opportunities to save and borrow. MFIs are managing 217 billion taka in savings and 584 billion taka in loan outstanding. Top 20 MFIs account for over 80% of the loans outstanding. MFI's annual non-performing loans is less than 2% compared to 11% of banks and NBFIs. MFI's loanable funds accounts for 35% of member savings, creditor assets used to refinance lending is 30%, and equity make up around 34%. But the basic pillars of MFIs, low-cost member savings and refinancing from wholesalers are under stress. Rapid expansion of new channels such as MFS and agent banking, which offer convenience and better prices for savings, are hampering low-cost member savings as a source of loanable funds. Refinancing through wholesale banks and institutions as sources of loanable funds are being squeezed as the refinancing market is becoming illiquid. Currently, MFIs are facing capital constraints. This problem is likely to become acute as MFIs are forced to reduce loan prices and increase savings to compete with newer channels and deal with legitimate political concerns on wide disparity in interest rates between the banking and MFI sector. Why does it matter if competition from new channels, capital squeeze, and public pressure gradually displace MFIs? It matters because customers value MFI's personalized service with a human touch and social interaction, resulting in investing in overall financial health of clients. What would managed MFI transformation look like? MFIs have lower operating costs, enabling cost of savings to be passed to customers. Key to this is digitizing business processes so that 3% to 4% can be shaved off prevailing MFI lending interest rates. MFIs have wider sources of capital from all savers, local or foreign wholesalers, investors, and capital markets by lowering costs to customers even further by spreading across a much larger capital structure. Key to this is flexible regulations for MFIs to compete on a level playing field. MFIs investing more in strengthening governance, improving risk management standards to offer confidence to savers, regulators, and investors that deregulation and accompanying growth will not pose risks to savers and investors. MFIs are part of an interoperable payment system, where they can cooperate and compete with other emerging channels and benefit customers with choice and convenience. Key to this is enabling regulations for easier collaboration amongst MFI, MFS, and banks. Regulators and policymakers can catalyze transformation of MFI's process through a tiered approach. Initially, by amending MRA Rules 2010, few MFIs may pave the way. This allows MFIs to mobilize additional savings, get loans from foreign sources, and consequently create pathways for access to capital market. Regulators may also enable certain MFIs to transition into specialized banks by amending Banking Companies Act 1991. For example, transforming top 10 MFIs will result in doubling the number of customers and 12 times growth in savings in 5 years. Hence, transformation is inevitable for the future of MFIs.